Brad Williams, Frugal Finance, Income Participating Securities, Overview and Functionality. An income participating security is a hybrid investment that merges features of both stocks and bonds, aiming to deliver a reliable income stream to investors. Typically, the IPS includes a bond component that pays interest and a stock component that distributes dividends. This structure allows investors to benefit from both fixed income and potential stock performance, offering a unique way to generate cash flow. Key highlights: an IPS combines elements of both bonds and stocks to provide regular income. The bond portion offers a higher yield compared to typical bonds. Dividends come from the company's available cash flow and may fluctuate based on the company's performance. The bond's interest portion is taxed as ordinary income. What is an income participating security? An income participating security, sometimes known as income deposit security, is designed for investors seeking consistent income. It is structured with two main components: a bond, which generates interest, and stock, which pays dividends. This structure is ideal for investors who prioritize income over capital growth. The bond part typically offers higher yields than conventional bonds to compensate for the more stable, low-growth nature of the issuing company. IPS securities are often issued by companies that do not expect substantial growth but have steady cash flows. To encourage investments in such companies, the IPS offers higher yields through its bond portion while also distributing dividends from the company's free cash flow. These dividends can vary, much like any stock dividend, depending on the company's earnings and financial situation. Trading and taxation of IPS. IPS securities are usually traded on exchanges, and the components, stocks and bonds, may be separated and traded individually. However, a buyer generally needs to hold the IPS for a specific period before being able to sell it. Regarding taxes, the bond interest portion of an IPS is taxed as ordinary income, while dividends from the stock component may fluctuate in terms of taxation. In some cases, a portion of the distribution from an IPS may be considered a return of capital, which is taxed at the lower rate for capital gains, currently 15%, rather than as ordinary income. Special consideration: it's important for investors to be aware that the income from IPS can sometimes be classified as return of capital rather than standard taxable dividend. This classification affects the taxation, as a return of capital is taxed at a lower rate compared to regular dividends. In summary, IPS securities offer a hybrid investment solution that combines the stability of bonds with the potential for stock dividends, making them an appealing option for income-focused investors. However, they come with tax complexities and varying dividend payouts, so understanding the specifics of these securities is crucial before investing. I don't know. I think if you wanted this, you could just buy short-term or mid-term bonds and then buy stock that are paying dividends. Give me your opinion. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.